I have some bad news and then I have some worse news. The central banks around the world have messed up, and they've messed up big. And they now only have two choices: let inflation run hot, which could lead to hyperinflation and crash the markets, or start raising interest rates, which is also going to crash the markets, because the markets are so over leveraged right now that even a 1% rise in interest rates will lead to a huge crash. In this video, I'm going to be going over Ray Dalio's warning. And if you don't know Ray Dalio, he's one of the best and brightest investors of our time. He too is also warning that the central banks and the Federal Reserve have stuffed up big, and there's either going to be monetary hyperinflation or they're going to have to raise interest rates to cool inflation. But either way, the markets are going to crash and a big crash is coming. I'm also going to go over the narrative of central banks, how they keep saying, look, we just want inflation to run hot because then that's going to lift unemployment and that's going to boost the economy, and we just want to help out the little guy. That's a complete lie. The people at the bottom get the money last and they get the crumbs, while billionaires around the world have almost doubled their wealth since the pandemic began. So this shows all these bailouts, all this stimulus, it just goes to the top, it goes to the 1%, and us, the people at the bottom, get the scraps. I'm also going to go over how this is going to affect the housing market and new trends in the housing market, and how this is going to affect the stock market. I'll go over what this means for you and what we can do right now to prepare, because many people are complacent in the markets right now, in the stock market. You got all these new rookie retail investors that have put money in and they've made huge returns, and they think, look, if a stock doesn't go up 10% in 3 days, they're going to sell it. And so all these retail investors, they call them paper handers, which means they sell very quickly. As soon as just a little hint of a crash comes, they're all going to sell, because they're not veteran investors and they're not long-term investors. They're just people that want instant gratification, and this is leading to huge financial instability because margin is so high in the stock market, and debt to incomes have never been greater in the housing market.
What we've seen this go around is the need to distribute, to produce a lot of debt. Where did those checks come from? They came from the government. The government wrote the checks, but the government can't produce money. The central bank can produce money. So the central bank had to print a lot of money to lend to the government to do that. And that's monetization. When you get at the late part of that cycle, where you're creating a lot more debt and then you're monetizing it, that's the end of that's near the end of a long-term debt cycle. And that produces its own set of problems.
Okay, so as you can see, the first part of this interview with Ray Dalio, which I think is absolutely brilliant, and what I've been thinking all along, is we're getting at the end of this 40-year debt cycle. And what that pretty much means is, for the last 30 years here in Australia and in the US, they've been dropping interest rates, which has meant people can service more and more debt, because the economy no longer relies on consumption anymore, it relies on debt. And people aren't spending their incomes now, they're spending their future income. And when you think of a Ponzi scheme is pretty much someone at the top that benefits the most, and it's a scheme that is unsustainable, and it's a scheme that relies on more people getting into it and putting more and more money in. Well, pretty much, if you think of it simply, this whole current financial system seems similar to a Ponzi scheme. It relies on more people getting into the markets, but now everyone's in the market, so it now relies on debt to keep the market going. But eventually everyone will get maxed out on their debt, so they need to drop interest rates so people can service more debt. But now interest rates are at rock bottom, so people can no longer service more debt, and there's no income growth. But for something that they've done for the first time in history, is governments monetizing their debt with the help of central banks. And what this means is a government can issue an IOU. So, hey, I issue an IOU, $100 out of nowhere, and they can say, look, we'll pay you back just 0.1% interest. But unfortunately, nobody would buy an IOU from the government for just 0.1% interest, or not many people have. And even Ray Dalio says he wouldn't get into bonds, and he says if you're investing in bonds, you're stupid. And same as Goldman Sachs. So what's happened now is the central bank's like, okay, no one wants these bonds, we'll come in and buy these bonds and we'll pay whatever price. So the government issues debts, the central bank comes up and buys that debt, then the government goes out and does something called fiscal stimulus, where they give stimulus checks, they build more infrastructure, they create all these schemes, and we're getting pretty close to something called universal basic income, which means soon there's going to be so much automation of the workforce, so much globalization of the workforce. There's going to be such high inflation that people simply aren't just going to be able to live, or just won't have the income or won't have the jobs to sustain their lives. So what's going to happen is the governments are going to have a universal basic income payment. And to fund that, they'll just keep creating more and more debt, let the central banks buy that debt from the government, and then they're going to create high inflation, which could lead to hyperinflation to devalue the debt, which means, say for example, they're $1 trillion in debt. Well, then they'll just devalue that $1 trillion to where it's worth half. And that means everyone's paying more taxes. It means prices go up, so the government's revenue go up, the GDP goes up, so they can service that debt. They've now admitted in Australia and in the US, there's no way at all they can repay the debt. So what they need to do is inflate away the debt and grow the economy faster than the interest. But unfortunately, throughout history, there's been many things called fiat currencies, which we have now, the US dollar, the Australian dollar, and guess what? Not 50%, not 75%, 100% of the time they have failed because governments get greedy, they devalue their currency to fuel their spending, and eventually people lose faith in the currency, and that what ultimately leads to hyperinflation. Not just printing of money, but losing faith in the currency. And I'm going to get into how this is going to affect the markets in a minute, so stay with me.
Yes, I think let's understand what's behind that. And then you can understand what the warning signs are, because it's just a manifestation. When there has to be a lot of selling of bonds, and bonds don't give any good return, there's a guaranteed negative return in bonds relative to inflation. Inflation index bonds yield minus 1%. And so there's no return. And there's a pile of people who own bonds. And this isn't just Americans, but these are international investors owning bonds. And they have to buy a lot more bonds, because when the government has to sell a lot more debt, that means they have to buy a lot more bonds. There will not be enough demand for those bonds. When that happens, interest rates rise. That's what you're seeing now. And the central bank is put in a dilemma. This is all classic end of cycle type of thing. The central bank is put into a dilemma because either interest rates will rise a lot, or they will have to print money and buy those bonds to hold them down. When they print money and buy those bonds to hold rate down, that lowers real rates, and it accelerates a depreciation of the value of the dollar. And it also raises inflation pressures. And what the imbalance, the frightening thing about this, is that if you get losing money, and people are losing money by holding bonds, and that's not just Americans, those are other foreigners, then they could sell bonds. And if they sell bonds at the same time as the government has got to sell a lot of bonds, that could produce a real dilemma. That's classic late long-term debt cycle type stuff.
And he's saying here, the central banks around the world, the Federal Reserve, the RBA, they're in a dilemma here. People around the world are selling bonds, yields are rising, interest rates are rising. But then if they go ahead and do something called yield curve control, a lot of people think they're going to do, then that means they're going to print way more money, and this is going to lead to high inflation. But then if they get high inflation and it leads to hyperinflation, then they're going to have to lift interest rates even more. And for every 1% lift in interest rates, house prices can fall 10 to 15% and the stock market can fall 10%. And everyone's got a short-term memory. They're thinking, we'll never have rates back up to 5% again. We'll never have rates up to 10% again. Well, it was really only 20 to 30 years ago that we had interest rates above 10%. And imagine how devastating that would be for the housing market and the stock market if interest rates just went up 3%, just to 3%. There would be mass defaults because people are leveraged to the T. What have central banks been saying? And they've never said this before. It's something that I think is quite suspicious. They're saying, come on in guys, take on as much debt as you can. And they've actually for the first time in history told people we're not going to lift interest rates for 3-4 years. So they're telling people how long it's going to be until they lift interest rates. So they're leading people in a false sense of security. And just a little side note here, the quote, "you'll own nothing and you'll be happy," is this how they're going to do it? They're going to get everyone in on low interest debt, then all of a sudden hike interest rates so people lose all their assets, and then the great reset happens and the global elites own everything. Just a little side note there. I wonder if that's how it's playing out. Who knows?
Well, as I said, think of the economy as being like an individual and their pulse is dropping. When the pulse is dropping, the doctors come running in with the stimulant and they inject stimulant. Now that the economy is rebounding, and inflation pressures are rebounding, there's not the same pressure to administer that stimulation. When it happens, when it becomes a problem, is first, the rising interest rates start hurting financial asset prices. First, typically, they hurt bonds. Then they pass through and hurt stocks because still interest rates affect stocks. And when that starts to affect stocks, that's one thing. Maybe the stock market can correct 10 or 15% and the Federal Reserve can tolerate it. When it goes beyond that and starts to affect the economy, that's when you see the real trade-off have to surface. So that's what that looks like.
And then he goes on to warn of there's two types of inflation. There's obviously the CPI and then there's a monetary inflation. And pretty much what we've seen lately is hyperinflation in asset prices because everyone's getting out of cash, everyone's getting out of bonds, and they're going into stocks, real estate, precious metals, and cryptocurrencies.
It's not an easy thing to change because what do? Spend less money. And if you spend less money, you give less checks out, or you can't get people to easily earn more money and change that. So it's a difficult dilemma, and it's a particularly difficult dilemma that I think that you're going to see, particularly the late this year and beyond that, because late this year, you're probably going to see everything be a problem. You're going to probably see higher interest rates because growth will be stronger, inflation will be stronger, and that you'll see probably there won't be enough demand on it. So the thing to watch out for as a signal, if this happens, is that you see the need to buy bonds when the economy is strong and when inflation. If you take, there's this year and then there's beyond this year. There's the next few years. It's a problem because how we're going to spend money is a political issue, a big political issue. And we're going to have to and there's going to be too much spending. And so that'll affect the value of the dollar and or interest rates.
So to put it simple, Ray Dalio pretty much says the banks are stuffed up and they're stuffed up big. The central banks, that is, around the world, in Australia, the US, Canada, UK. And we're pretty much going to lead to a crash either way. Either we're going to get high inflation, hyperinflation, or they're going to have to raise interest rates, or bond yield rates are going to skyrocket, which is going to crash the markets as well. And central banks around the world now are admitting, hey, we want inflation, we want high inflation, when they pretty much never said that before. They've all said they want to be in their 2 to 3% range, but they're now saying we're going to go over that, but it's okay, it's only temporary. But they can manipulate the numbers all they want, even if they come and say, oh, we tried to get 3% inflation, but it's only 2%. I know, and you all know, everyone in the comment section knows that the CPI is CPI. They can fudge the numbers, mix the numbers around any way they want to make it look, to give the number that they want to put out there. But I think inflation is minimum 5%. Look at electricity prices, look at housing costs, look at rents, look at insurance, groceries, commodities. They're all going up much faster than 2 to 3% per year. And the RBA has come out and said to Josh Frydenberg and Scott Morrison, hey, we can get inflation even lower to 4%, maybe even below that, even the 3s. So keep on printing money, keep on giving fiscal stimulus, keep on pumping up those zombie companies. And in Australia, guess what? Many companies made huge profits in 2020 and they got JobKeeper as well. They got billions and billions of dollars of our money, our tax money, even though they earned huge profits and they gave that to shareholders. And one thing you have to know why the housing market is booming so much right now is because there was such a sharp drop in interest rates. Interest rates dropped around the world around 1%, so the housing markets are now pricing that in, and house prices can rise 10% when interest rates drop 1%. But now they're getting close to pricing that in, and interest rates are rising, so we could see the housing market slow down very quickly. And if interest rates rise in 2022, we could start to see house prices dropping as early as 2022. This also goes along with, in New Zealand, they've actually scrapped the tax benefits for investors. They could claim interest on investment properties, And there's going to be a lot of calls in politics and politicians for this moral hazard. They're going to start wanting it in other countries, like in Australia, in the US. They may start to lobby to say, hey, houses are getting too unaffordable. Let's punish these investors. Let's remove negative gearing. Let's remove all these tax benefits for claiming interest on loans. And that may be another risk for the housing market, is political changes and tax changes to drop prices. So guys, I urge you, don't FOMO in right now. We're in euphoria. We're at the end of the debt cycle, according to Ray Dalio. The central banks are in a bad position. They're either going to have to let inflation run hot, which could lead to hyperinflation, or they're going to have to lift interest rates. And either way, each road leads down to a huge market crash. And we're really in the eye of the storm, I think, right now. All the retail investors are in, everybody's in the markets, and that's when we're normally at the end of the market. And there was a quote from a great investor just before the Great Depression stock market crash, where a shoe shine boy was shining the stockbroker's shoes. And he started talking to him about stocks. And the investor was like, okay, the shoe shine boy is talking about stocks, now it's time to get out. And have you guys noticed that your friends at the barbecue, all these people that don't invest or don't know much about the markets or don't normally get in the housing market or invest in property, everyone's talking about investing right now. Everyone's talking about the stock market, the housing market, all these retails that normally wouldn't. And that's a sign that we're at the peak and a big crash is coming, just like the quote from the Great Depression when the shoe shine boy was talking about stocks. But you're probably wondering, okay, a big crash is coming. Well, what can we do?
So Ray, you're recognized as one of the great investors of our age. So give us some investment advice here. Given what your analysis of how this works, what's going to happen, given what we're doing right now, what's the best investment? We heard Jamie Dimon just recently say he wouldn't touch a 10-year treasury bond with a 10-foot pole.
Well, I wouldn't touch a 10-year treasury pole, the 10-year fold either. Cash is trash. In other words, it looks like a low risk thing to hold, but it's not, because when you have a zero interest rate, or in some cases in foreign countries, slightly negative interest rate, and you have an inflation rate of 2% or higher, you get taxed at a rate, essentially you lose buying power at a rate of about 2% a year, and that's a lot. You lose a lot of buying power. And so this is one of those environments you don't want to hold cash. If anything, maybe you borrow some cash and find something that has better than a zero interest rate in it, or something that has inflation. If you bought the average thing, which is inflating at 2% or more a year, you'd be better off. However, so then the other thing you need to do is diversify well. Okay, so don't have cash, and then you need diversification, and the diversification should be currency diversification, country diversification, as well as asset class diversification.
Well, what Ray Dalio said, and what I agree with, is you want to diversify. You don't want to be all in on stocks. You don't want to be all in on real estate. You don't even want to be all in on gold. There's a lot of doomsdays that say go all in on gold or Bitcoin, but really you want to be diversified. You want to have multiple assets. You want to be in either, again, this is not financial advice, just what I'm doing is I'm diversifying into Bitcoin, precious metals, stocks, defensive stocks that are going to do well in a recession. I've already got my own home, so I'm diversified into real estate, and that's what I'm doing to prepare. And even you want to be diversified across countries. He said you can even have different currencies. I'm not really into that type of thing, but if you are, you could do that. And he also says you can be in different markets, not just the US market, you can be in Asia market or other countries' markets. For all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you all updated on the latest housing market, stock market, and global finance news. I'll pop up some other videos here. I'll see you there.